welcome back to this week's market update. Today is June 23rd, Friday morning here, 2023. We are super excited to bring you another week of economic updates, so let's jump right into it. In a quieter and shorter week this week, with the holiday being on Monday, we saw all three major indices fall as of close on Thursday, with some residential real estate data showing that the market's starting to cool off here. The initial claims data showed continued tick up in claims, not anything alarming, but definitely a tick up for sure. And we also got the leading economic indicators index pointing to an economic slowdown as well. So we saw the NASDAQ composite fall just about 0.4%, the S&P fall about 0.6%, and the Dow fall just over 1%. So a bit cooler of a week, bit soft, but overall lots of good data here. Jumping right in here on Tuesday morning, we got May residential data, including housing permits, starts, and completions for the month of May, and it came in quite a bit stronger than expected. So permits were announced at 1.49 million here, which was almost 6% above the estimates. We had housing starts at 1.63 million, which was 16% above the estimates, so it's very strong housing permits and starts. On the other hand, we got the 1.5 million in housing completion. So, still seeing a good amount of housing starts, completions, etc. in the new residential space. So good news if you were looking for a new construction home. But again, we still haven't seen a huge hit to residential real estate, even despite the higher mortgage rates. So, we're seeing a lot of homeowners hold really tightly onto their lower interest rate mortgages. So obviously fewer are willing to sell in this market, but hopefully, supply and demand will even out soon. In that same train of thought, we also got existing home sales for the month of May, when home sales were down 20.4% just from a year ago. So they were still, fairly strong at 4.3 million with kind of the spring home buying fever. And they were up slightly month over month, but again, 20% down from a year ago. And I think most of this has to do with the higher interest rates, because obviously you don't want to sell a house when you have a low, really affordable mortgage, and you don't want to buy a house when there is a higher interest rate and a higher mortgage payment. So that definitely is a huge impact on that. We also saw inventory sitting a bit longer than it did a year ago at 3 months. And the median sales price, again, still quite hot, still, close to 400 grand there, but it is down 3.1% year over year. So lots of movement in the residential real estate space, lots of data this week. And we're going to continue to monitor this as, other things like the job market and other sorts of things like that affect these sorts of data points. Also, a little bit related to residential real estate, and that the job market plays a huge role in how real estate is doing. We got initial claims for the week ending June 17th, and that came in at 264,000 for last week. And that was just about the same as the previous week, but it did pull the 4-week moving average up to almost 256,000. So definitely a trend up since about the end of January, beginning of February, as labor market conditions soften and macroeconomic headwinds kind of make their move on the job market. So not anything of concern, especially, the unemployment rate still under 4%. Nothing is super concerning in terms of that, but we are keeping an eye on these really important data points. A final data point this week as we close up this slower week, we got the leading economic indicator index for the month of May. It declined just about 0.7% month over month, so not a huge movement in that, but we are definitely still in the negative zone. So you can see here the last 3 times that happened, where we were, between -5%, -10% year over year. We have had a recession. We're either in a recession or we have had one. So only time will really tell exactly what this slowdown is going to look like. Is it going to be a full-blown recession? Is it going to be just a slight slowdown, softening in labor markets? We're not 100% sure. There's going to be some sort of slowdown. Not sure what industries will be hit the hardest, but basically this index is pretty accurate. So we are definitely taking a look at this. And, things that were feeding into it that definitely made it fall. We had ISM New Orders Index, the negative yield spread in the treasuries, and just tighter credit conditions as the banking uncertainty still kind of has its impacts on the, lending market. So lots of stuff to look at as we continue to monitor the markets and adjust portfolios as necessary, but all great stuff for sure. This week was definitely more quiet, yet still important, full of economic data from the residential real estate industry, the employment situation, and just overall macroeconomic conditions. Slowly but surely, we're seeing the US head towards a slowdown of some sort, like I was just saying, according to these sorts of evidence that we look at here in these data points, but we will continue to monitor markets and these data points diligently. So thank you for tuning in, and we will see you next week.